Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all these financial reports these companies put out there. Because if you think those earnings call transcripts are fun, buckle up because we're diving into MSCI Incorporated latest 10K report. And if you want to get a deeper dive into these documents and discuss them with fellow enthusiasts, join our Discord community, linked in the description below. Alright, let us look at MSCI Incorporated fiscal year that ended the 31st of December of 2025. MSCI, they provide finance stuff data analytics indexes. These are the building blocks for so many investment decisions globally. They help big investors understand risk, make better choices, and even find new ways to invest. Pretty much everyone from huge banks to pension funds, all the way to smaller asset managers use what MSCI provides. They operate across different segments like index analytics, sustainability, and climate, and even private assets. This 10K filing is basically their annual checkup with the market, and it gives us a full picture of how they did over the last year. It covers a lot from business operations to risks and of course the financial results that everyone wants to know about. At its core, MSCI helps investors understand the complex world of finance. They provide the tools and information that allow investors to build portfolios, construct strategies, and manage risk. They use cutting-edge technology, including artificial intelligence or AI, to make their products even better and more helpful. And they are a global player serving about 6,800 clients in over 100 countries. Now that is some serious reach. One thing that stands out immediately is their client concentration. Their biggest client, BlackRock, accounted for a significant 10.8% of their total revenue in 2025. That is a lot of eggs in one very large basket. While BlackRock is a massive client, this does highlight a potential risk if that relationship were to change. Now, no company is without its risks, and MSCI is no different. Their report details a laundry list of potential problems. They worry about relying too much on outside data providers' errors in their own systems, and reputational damage if their calculations or ratings are questioned. They also point to the impact of cyber attacks, which is a constant threat for any tech-driven company. There is a huge risk of undetected errors in their products, given that trillions of dollars in assets are managed using their indexes and analytics. Faulty calculations could lead to massive problems and lawsuits. They also call out the growing complexity of their products, especially with the rise of AI, which can introduce new and unpredictable risks. Their reputation is everything, and they are keenly aware of it. Any perceived bias in how they construct indexes or rate companies, especially on sensitive topics like ESG or environmental, social, and governance factors, could seriously hurt their business. They are also worried about public and media scrutiny around these issues. Let us talk about the money though. MSCI has taken on quite a bit of debt. They have over $6 billion in senior notes outstanding, and even more in their revolving credit facility. This level of debt can strain cash flow and limit their flexibility, especially if interest rates go up. Okay, so let us get to the numbers, the heart of this filing. For the year ended the 31st of December 2025, total operating revenues jumped up by a solid 9.7%, reaching over $3.1 billion. That is a good growth number. This growth was mainly fueled by an increase of $164 million in recurring subscription revenue, and a very strong $113 million jump in those all-important asset-based fees. Looking at the breakdown of their revenue streams, we see a clear trend. Recurring subscriptions are growing steadily, and asset-based fees, which are tied to the amount of money invested in products that use MSCI indexes, saw a significant jump of 17.2%. This is great news because asset-based fees are a direct indicator of how much money is flowing into the investment products that rely on MSCI. And speaking of assets under management, or AUM, that figure for ETFs linked to MSCI equity indexes has been skyrocketing, reaching over $2.3 trillion by the end of 2025. That is a massive increase from the previous year and a strong sign of confidence in MSCI's products. Their sales figures also look healthy, with total net sales showing a positive 3.3% increase year over year. This shows they are bringing in new business and keeping existing clients happy enough to renew their subscriptions. Their retention rates across segments are also quite impressive. For instance, in 2025, the overall retention rate was 94.4%. That means they are keeping most of their recurring revenue clients, which is crucial for predictability and stability. Even with some quarterly dips, the overall picture is very strong client retention. Now let us talk about profitability with adjusted EBITDA. This metric climbed by a substantial 11.1% to reach over $1.9 billion. Their adjusted EBITDA margin also improved slightly to 60.8%, which indicates they are managing their expenses well while growing revenue. This tells us that even though their operating expenses grew by 7%, its revenue growth outpaced it. The index segment is clearly their powerhouse, generating the most profit and growing robustly. It accounts for the lion's share of their revenue and their adjusted EBITDA margin. There is a fantastic 76.4%. The analytics segment is growing too, though, at a more modest pace, with its operating revenues up 5.8%. The profitability there is a bit lower, with a margin of 47.9%, but still solid. Sustainability and climate is the fastest growing segment, with revenue up 8.4% and adjusted EBITDA jumping a huge 22.7%. This shows that their focus on ESG and climate-related investing is paying off, and they are becoming a key player in this increasingly important area. And their private assets segment is also chugging along with 8.1% revenue growth and a respectable 13% jump in adjusted EBITDA. Looking at liquidity, MSCI has a strong cash flow from operations reaching nearly $1.6 billion. They have a good amount of cash and cash equivalents and access to a significant credit facility. This suggests they have the financial muscle to continue investing in the business, making acquisitions and returning capital to shareholders. Geographically, MSCI is well diversified, with significant revenue coming from the Americas, EMEA, and Asia, Australia. This geographical spread helps mitigate risks tied to any single region. Now, the auditors, PricewaterhouseCoopers LLP, have given them a clean bill of health. They found the financial statements to be fairly presented, and that the company's internal controls over financial reporting were effective. This is always good to see. So what is the story here? MSCI is navigating a complex financial landscape extremely well. They are growing revenue across all segments, profitability looks strong, and their client retention is commendable. Their investment in AI and sustainability is clearly paying off, providing growth avenues. Their strategy to lead in research, extend their content across asset classes, and really push sustainability and climate integration is working out. The acquisitions they have made also seem to be fitting into their overall plan. However, the reliance on BlackRock as a major client remains a point to watch. The significant debt levels also require careful management, and the increasing use of AI, while a huge opportunity, also brings its own set of risks and costs that they are very upfront about. Overall, MSCI seems to be in a strong position. They are a leader in essential financial infrastructure with a recurring revenue model that is showing resilience and growth. Their ability to adapt to new trends like AI and sustainability is a key strength. The financial performance for 2025 is very encouraging, showing robust growth and profitability. Alright, that is our deep dive into MSCI Incorporated latest filing. What do you think about their performance and their strategy for the future? Are you impressed by their growth or concerned about their risks? Let me know your thoughts in the comments below. Hit that like button if you found this breakdown helpful, and subscribe for more corporate dissections. And hey, do not forget to join our Discord community, linked in the description, for even more discussions. Thanks for watching, and we will see you in the next one.